Breaking news! If you've got a savings account in the UK, you'll definitely want to hear this. HMRC has recently clarified the rules around a crucial £10,000 tax threshold that could directly impact your savings interest, and it might surprise you. Whether you're saving for a rainy day, building a nest egg, or just earning a bit of interest on your cash, this update is something every UK saver needs to understand. So, before we dive into the details, don't forget to subscribe to my channel for more financial updates that actually matter to your pocket. Now, let's get straight into what HMRC has said, what it means for you, and how you can stay on the right side of tax laws while making the most of your money. Recently, a curious taxpayer took to social media to ask HMRC a question that's been on the minds of many savers: what actually happens if someone earns interest from their savings? Do they need to report it themselves, or does the tax system handle it automatically? Specifically, the question was whether a taxpayer needs to inform HMRC and file a self-assessment tax return if they earn interest on their savings, or whether HMRC adjusts the tax code without requiring any action. In response, HMRC issued a detailed explanation that has since helped clear the fog for many people, and it's something you should know too. According to HMRC, if your total income from savings interest is more than £10,000 in a tax year, you are required to declare that income through self-assessment. That means completing a tax return, even if you're employed and your employer usually handles your taxes through pay. On the other hand, if the total interest you earn from savings is less than £10,000, then you don't necessarily have to file a full tax return. Instead, you can report it through the pay-as-you-earn system. But the real question that followed was, how exactly do you declare this interest through pay, and when do you need to do it? HMRC explained further that the key lies in understanding how your personal allowance and other savings tax reliefs work. First, your personal allowance, currently £12,570 per year, is the amount of income you can earn before paying any income tax at all. If you haven't used up your entire personal allowance through your salary, pension, or other income, then you can apply the remaining allowance to your savings interest, meaning some or all of it could be completely tax-free. This is especially useful for part-time workers, students, or retirees who don't have high incomes but do have savings. But that's not all. HMRC also reminded savers about the starting rate for savings, which allows up to £5,000 in savings interest to be tax-free on top of your personal allowance, but only if your other income is relatively low. Here's how it works. For every £1 your income exceeds the personal allowance of £12,570, your starting savings rate is reduced by £1. So, if your total income is under £17,570, you might be eligible for some or all of the £5,000 starting rate, but once you hit that upper limit, the benefit disappears entirely. In other words, this tax perk is designed to help low-income earners keep more of their savings interest. Still with me? Good, because it gets a little more nuanced. In addition to the personal allowance and the starting savings rate, HMRC has set up the Personal Savings Allowance, PSA, which is more widely applicable and depends on your tax band. If you're a basic rate taxpayer, that means your total income is less than £50,270, you can earn up to £1,000 in interest completely tax-free, regardless of your personal allowance or starting rate. If you're a higher rate taxpayer earning between £50,270 and £125,140, your PSA drops to £500. And if you're among the highest earners, paying the additional rate of 45%, you don't get any savings allowance at all. That's right, zero tax-free interest for additional rate taxpayers, so it's crucial to know where you stand. Now, if you're wondering how HMRC knows how much interest you've earned, they've got that covered too. According to their guidance, most banks and financial institutions will issue a certificate of interest or a tax summary after the end of the tax year. This document outlines exactly how much interest you've earned, and it's your responsibility to either declare that amount or make sure it's been reflected in your tax code. If your total interest is under £10,000 and you're paying tax through pay, HMRC might automatically adjust your tax code once your bank reports this information, but it's always wise to double-check. Mistakes happen, and it's ultimately your responsibility to ensure your taxes are correct. Of course, if you want to avoid paying tax on your interest entirely, and who doesn't, one of the most effective ways to do that is by using an ISA, or individual savings account. Interest or investment growth earned within an ISA is completely tax-free, no matter how much you earn outside of it. The ISA allowance for the current tax year is £20,000, and you can split this allowance between different types of ISAs, such as cash ISAs, stocks and shares ISAs, or even innovative finance ISAs. So if you haven't maxed out your ISA allowance, and you're earning taxable interest elsewhere, consider shifting your savings to an ISA to legally reduce or eliminate your tax bill. Now, all of this tax planning becomes even more relevant when we consider the broader economic context. In August, the Bank of England made a significant decision to lower the base interest rate from 4.25% to 4%. This move directly affects how much interest banks are willing to pay on savings accounts. Historically, when the base rate drops, savings providers tend to follow suit and reduce their own interest rates, which means lower returns for savers. So while you might be earning less interest than you were a few months ago, you still need to be aware of how much you're earning, especially if your savings are spread across multiple accounts or platforms. And with the next base rate decision scheduled for September 18, there's even more uncertainty on the horizon. Will the Bank of England continue to cut rates in response to inflation trends, or will they hold steady? No one knows for sure, but what we do know is that every change in the base rate can have a ripple effect on your savings returns and, in turn, on your tax obligations. That makes it more important than ever to stay informed, track your interest earnings, and understand the rules around savings tax. So, to quickly summarize, if your interest from savings exceeds £10,000, you need to report it via self-assessment. If it's under that amount, you might be able to report it through pay provided your tax code is adjusted correctly. You can reduce your tax bill by using your personal allowance, the starting savings rate, and the personal savings allowance, depending on your income level. And don't forget, ISAs offer a fantastic way to shield your interest from tax altogether. With banks changing rates and tax laws constantly being updated, keeping track of your savings and how they're taxed is not just a smart financial move, it's essential. Make sure you keep an eye out for interest certificates from your bank at the end of the tax year, and don't assume HMRC has automatically sorted everything. Take control of your finances by knowing what you earn, where it comes from, and how it's taxed. If you're unsure about your tax obligations, speak to a financial advisor or visit HMRC's official website for up-to-date information. That's it for today's deep dive into HMRC's £10,000 savings rule, a topic that affects millions but is often misunderstood. If you found this video helpful, subscribe to my channel for more practical financial guides, tax tips, and money-saving insights that can help you keep more of your hard-earned cash. Hit the like button, share this with anyone who has a savings account, and drop a comment below if you have any questions or experiences to share. Thanks for watching, and as always, stay smart, stay informed, and take control of your financial future.